Money moves without permission, power moves with it. To understand what's happening, you need to understand one concept: monetary velocity. Not the money supply, not inflation. Velocity, how fast a unit of currency changes hands inside an economy. Central banks have always controlled the supply of money, but private stablecoins introduced something they had never faced before: a parallel settlement layer they couldn't see, couldn't slow, and couldn't tax. Think about what that actually means. A factory owner in Lagos can convert Naira to USDC, move it to a wallet in Dubai, convert to dirhams, and settle a trade all before a correspondent bank in London has even opened. The transaction is settled, the capital moved. No SWIFT code, no clearinghouse, no sovereign oversight. SWIFT isn't slow because of old technology. It's slow because governments need the delay. That delay is where fiscal policy lives. That delay is where sanctions enforcement lives. That delay is where capital controls live. Private stablecoins didn't just compete with banks, they erased the friction that governments depend on to govern. And here is what that friction actually does. When capital moves through traditional correspondent banking, it passes through at least 2 clearing intermediaries, sometimes 5. Each one is a checkpoint. Each one is a point where government can freeze, flag, delay, or redirect. That's not inefficiency, that's infrastructure. Sanctions enforcement depends on it. Counterterrorism financing depends on it. Tax treaty compliance depends on it. Capital flight controls in emerging markets depend on it as well. Private stablecoins eliminated every single one of those checkpoints. Not deliberately, not as an act of defiance, just as a feature. And governments don't react to that slowly. They react to that with a coordinated multi-year regulatory offensive disguised as consumer protection, which is exactly what the 2026 standards are. Now let's get specific, because this is where the policy becomes predatory.